3.
RTHK Radio 3.
The time's 8:24. The Japanese yen has fallen against the US dollar for the 12th consecutive day. That's the longest losing streak in at least 50 years. It's down 0.5% this morning at 127.05 against the dollar. And yesterday, Bank of Japan Governor Haruhiko Kuroda warned of very rapid moves in the currency, but vowed to keep adding monetary stimulus to the economy. On the phone now from Tokyo is Nick Smith, Japan strategist at CLSA. Morning, Nick.
Good morning to you.
So perhaps you can explain for our listeners what is going on with the yen. Why is it so weak?
Sure. The main thing that's been weakening the yen is that U.S. interest rates are going up and Japanese interest rates are shackled at zero. That's the main thing. So the real yield differential is correlating very strongly with the yen. The other thing that tends to move the yen is the current account surplus. So perhaps easiest to think of that in terms of the trade surplus, but it's importing more than it's exporting at the moment for the simple reason that its nuclear power plants are switched off, and therefore it's sucking in a certain amount of oil from outside that it wouldn't otherwise be. And the solution to that is switch them back on again. But we've had a slide in the yen of about 10.5% since the start of the year. Now, obviously, we've got upper house elections on the 10th of July. So common sense and politics are different. And particularly in this sense, the politics is focused on, well, won't this mean increased costs for consumers? And yes, that's true. That energy added all together is about 7.1% of the consumer basket. But also, a weaker yen is very good for corporate Japan, which is something that Governor Kuroda, the governor of the Bank of Japan, has said repeatedly. So he's backtracked a little bit recently, saying that sudden moves are not terribly helpful. And that's true. It's really tough for a company to have to handle these massive swings in the currency we get. But he's certainly not backing off his point that, one, he needs to keep interest rates down, and two, that a weak yen is actually plus minus positive for the economy.
So how much is the Bank of Japan's policy itself contributing to this? Because they're trying to keep the 10-year bond yield at 0.25% when the US 10-year yield is heading very rapidly to 3%. Is it sustainable, this policy, without completely sacrificing the yen?
Well, it's entirely sustainable, but there would certainly be a political argument about it. How much does it contribute to it? Well, currency markets switch from one thing to another. So in 16, 17 and 18, then it was the real yield differential that was really moving the currency. And then we went for a couple of years when there was no correlation at all between the two. And now we're back into to that being the primary thing that's moving the currency. He can continue to do it, and he continues to feel that low interest rates are good for the economy as a whole. I'm not sure that I would agree. I would say corporate Japan is absolutely awash with vastly more cash than is good for it, and households are cash rich, and the only people who are short of money is the government, which is a very good place to keep a government. But he's holding the interest rates down. It feels more like religion than like science, but that seems to be what will continue while he remains governor of the Bank of Japan, which is about one more year.
Could this end up, though, being self-defeating and damaging the economy in the end? Because one of the problems with your currency falling is that it erodes real wages, which in turn dents consumption. So it's going to, at some point, if it's not already, isn't it damaging to the economy?
Well, I mean, wages have not moved in 30 years. So in PPP wages in Japan are 3% above where they were in 1993, whereas US wages are 47% higher. I think that's got much more to do with productivity than it has to do with the currency. And I would say that wage negotiation in Japan is kind of dysfunctional. The unions are certainly not really pushing for for big increases, and it's a very odd situation when the Prime Minister has to get involved in pushing for higher wages and recently offering big tax breaks. And even that's not proving enough to get wages up. So, yes, we're going to have a problem this year with... we're about halfway through wage negotiation reporting, but at the moment it looks like wages up 2.11%. Taking out promotions and seniority, that's just 0.8% increase. And by the time we get into March, April, then inflation is going to be popping above 2%. So that's going to be a real discussion. And the Prime Minister did try very hard in trying to help those wage negotiations, but thus far it seems to have failed. So I think the result is going to be that we're going to be looking at the possibility, with a very, very tight labour market, of perhaps an increase in job hopping.
OK, well, Nick, I'd love to talk to you a bit more about this, but sadly we've run out of time. Thank you very much. That's Nick Smith, Japan strategist at CLSA in Tokyo.